All righty, let's welcome everybody to Morning Fuel. We're going to talk a lot about private equity, the models. Is the capital market broke? What do we do? I want to preface this by saying, we're going to turn everybody's, they'll be on mute, everybody. And if you have a question, just as usual, just put it on the chat. One of the things that we're trying to do at the Petroleum Alliance is to come up with timely topics. I'm just telling you by the amount of folks. I'm kind of the private equity poster child. I did a whole bunch of private equity deals, and I get called a lot. And right now, depending on what publication that you look at, we've lost somewhere between 8,000 and 10,000 jobs in Oklahoma in the oil and gas business. I was looking at some of the more national numbers, and I think they've got it pretty wrong how they're doing it. But they're showing over 100,000. We think it's more like between 300,000 and 400,000 jobs have been lost. And so with this much displacement, everybody is kind of rallying together. We're trying to get our brethren in, more and more people joining the Petroleum Alliance so we can try to help them with our economies of scale we have, like for insurance and things like that. And other programs, especially programs like this, where they get a chance to talk to guys that are been in the trenches for a long time in the capital game. I'd like to now introduce our three guests today. These are in no particular order, or it's not least favorite to favorite or favorite to least favorite. But I'm going to start out with the most handsome one is Chad Michael. You guys all know him he's been at Tudor Pickering for quite a while. Many of us said no, he came over from the dark side. He was at JP Morgan before that. But he's been at TPH so long that I don't even remember. He's a Rice University guy, Houston guy. But he is an Oklahoman, although that's probably a well-kept secret, but he is a Southeastern Oklahoma guy. So proud to have him on. Chuck Yates, one of the pioneers, he was one of the guys that started up the Kayne Anderson's practice, private equity practice way back in 2001. I actually did with him and Mike Hines, I did 3 deals with them over my tenure. I even remember him back at Stevens, so that's really going way back. So we're proud to have him. He just recently retired. I think that he said, "Hey, Mike, I'm retiring and you can't leave because of our key man, so I'm out of here." And Hines was just still there, right?
It was a conscientious decoupling. Let's just call it.
I think he ran, but and that we'll have to get Hines on here to get the real story. And then last but certainly not least, Mike France. I worked with him a couple of iterations at First Reserve. He is now joined Intrepid. They're in the middle of the advisory game, and what Mike does is they have a fund and works with portfolio companies and also some more targeted fundraising for different strategies, and hopefully we can talk about that some. So I'm gonna let in that order. I'm gonna let you guys just take a few seconds and a piece and say kind of give us kind of the state of the union from the capital markets and from private equity, and then we will start asking a whole series of questions. So Chad, why don't you kick it off?
Sure. Thank you, David, and it's a pleasure to be here. I appreciate you assembling this group, and I appreciate the audience. So thank you for that. As Dave mentioned, I am an Oklahoman by birth and still by allegiance and spirit. So anything related to the state is certainly important to me. So it's good to be a part of this discussion for that, for sure. As we think about the State of the Union, I would just say it's characterized by beginning to come out of its shock. I would say when you think about what we all experienced in the first and early second quarter of this year, it was that was a period of time that I don't think anyone has been through, whether you've been in this industry as long as anyone, or whether you just came to this industry by definition, not been through something like that. And so that shock is now actually starting to give way to a bit of thinking. And so I would just say that, our dialogue has started to evolve now to be a bit more forward-looking, as opposed to just more dealing with immediate, issues that are popping up. So I think we all know the broader state of the union, and we all know how difficult the industry is, and we all know the challenges that we will face. But I would say that I would just start by saying that I am seeing some green shoots of some forward-looking discussions and some forward-looking ideas, which I think does underscore, ultimately, the resilience and the proactivity of this industry. Not to, and what that is not to suggest that there aren't some real challenges still in front of us. But I would say, Dave, we are beginning to come out of the shock is where I would start my comments.
Chad?
One thing maybe just to give some context to what we're going through is, at the end of the day, Finance 101 that we all learned kind of the first day of business school is, at the end of the day, capital chases certain returns based on certain amounts of risk. It's just that simple. And I think we forget that a lot of times that's much more a relative game as opposed to an absolute game. And what I mean by that is we kind of get stuck in our ways that PDP is worth PV10 and PUDs are worth PV25 or whatever the case may be. And when you look at kind of capital's actually sitting there going, all right, a 25% rate of return to go drill a horizontal well, frack it, product prices are going to bounce around. Why would I want to do that when Amazon's up, 125% over the last 6 months? And so I think a lot of what the rationalization we're going through here is figuring out exactly what is the underlying risk to the industry, the various components of the industry. How does that compare with owning technology stocks, owning bonds, owning gold, owning silver, and the like? And the capital's going to have to kind of sort through and figure out where it wants to be, while the industry's sorting through, okay, are we the provider of the marginal barrel to the world like we have been the last, call it, decade? Or are we just going to produce out our wells and pay down our debt? And, it's going to be the age of the plumber. And I've actually stole that term from Tommy Noose over at Oasis. So I think those are the two big things going on. And every time we as energy folks sit around and talk about capital and private equity and all that, we're not in our little bubble anymore where the world thinks 10 or 15% of their portfolio needs to be in energy. They're sitting there comparing us to every other thing, buyout, venture, technology, et cetera. And we just need to keep that in mind when we're weighing kind of what we should pay for things, what kinds of rates of return we expect.
Mike, you got some addition?
Yeah, no, I think those are, both spot on. I mean, you're starting to see forward-looking conversations, as Chad mentioned. That being said, I think sort of expectations and returns are slowly getting reset here. I think private equity generally is still kind of on the sidelines for a few reasons. I mean, I think one, need some stabilization in the market, but also, there's a pretty big focus, both private equity, the RBL banks, on their existing portfolio and having to kind of work everything through, their existing investments and portfolio before they can really start focusing or want to focus on anything new. There's also just limited debt capacity. RBL banks aren't really providing new credit. So as somebody is looking at new investment opportunities, to Chuck's point, the return threshold's already gone up. And then you're also doing that without the availability of, what has been cheap capital through RBL banks. So I think that just makes return expectations and opportunities that somebody needs to find need to be that much better when you don't have the ability of, cheap leverage to help out. And then you still have sellers who are working through their own sets of issues. And do you have willing sellers? A number of opportunities that have come have, whether it's disparate group of RBL banks, different shareholders who all are trying to work through, their own initiatives and incentives before they decide whether they actually want to sell and at what price. And so there's just a lot of movement still working its way through the market before I think you start really seeing private equity coming back in and putting any meaningful amounts of capital to work. I mean, all we've really seen at this point has been, some private equity firms, existing portfolio companies doing some bolt-on acquisitions that may sort of help their existing footprint. But as far as, really new entrants by whether it's, existing teams that have capital or private equity stepping into a new situation, we haven't seen much of that yet. I think everybody's on the sideline, anxiously waiting, feeling there's going to be good opportunities. But a number of these situations have to continue to work themselves out over the next, few months to quarters.
I think with the private equity discussion, I think the part of the model that's broken is the double promote scenario. What strategies do you think are coming in view? I know Chuck probably has some commentary about some of the things they did at Kayne, but what kind of strategies do you think are going to take that place, or these private equity guys are going to morph into? That could be anybody's question.
Maybe I'll just go first real quick. At least what we were seeing is you made this transition really kind of over the last couple of years from, what I call the good old days, buy some acreage, get a core on it, and then sell it for 3 times what you paid per acre, or, worst case, drill 5 to 10 wells and then flip. As you move from that to really having to develop your assets, turn it to cash flow, so you at least had a shot to get it sold or merged with someone, you definitely went to longer hold periods. And the whole model of dangling, a big promote in front of management with a low salary just became less and less of an incentive. And so one of the things you were having to think through was just, if we're going to have a longer hold, is there a way that we can get higher salaries? Because at the end of the day, you don't want management team to feel like they got a lottery ticket, or the flip side of that, you don't want management team to kind of see this prize as not as something you can maximize at the end of the day. And so we were already kind of working through higher salaries, lower promotes on the back end. And I think you're going to see more of that, because if you go into the buyout world, and I don't know buyout very well, but just the anecdotal stuff I've seen, they pay salaries that look somewhat like public companies, and maybe management's getting 5% or options for 10% of the company, as opposed to, in some of these cases, the higher end of the hurdles are 50% to management. So I definitely think you're going to see the evolution that way. And I think, historically, it always made a lot of sense for management to go straight and talk to LPs and cut out the private equity folks. And we saw that happen a bunch. At the end of the day, not a lot of those situations seem to work out very well. And so there is going to be a balance and a role to play for the private equity, the management team, and the LPs.
Yeah, I think the way, to Chuck's point, the way LPs are sort of managing that, it feels like, is I think they still see the value in going through private equity and having a GP sponsor there leading and running a transaction versus going direct to management. But the way they're reducing kind of the double promote and fee that you mentioned, Dave, is a much bigger focus on co-invest. So there may be a smaller amount of capital that's actually in someone's fund that's available for the GP to invest as it sees fit. And instead, it's more discretionary capital that LPs are offering up as incremental co-invest alongside a deal, or maybe even just having discretionary pools of capital along with GPs. And so I think is why you're seeing a number of just one performance-based, but also just the desire of LPs wanting to have more direct influence. You're seeing fund sizes come down to having less kind of blind pool capital available and more LPs wanting to have discretion over where capital goes. So it's either in the form of co-invest or sort of a direct vehicle with sponsors.
So that makes sense that the fund size comes down because there's an anticipation that certain LPs can pick and choose particular investments to invest directly in. So they're and maybe it I would suspect it, and I don't know for everybody here, but that it actually gets a different type of promoter. It's right alongside. It has a little different economics. Yeah, that's interesting. Chad, what are you seeing on that front?
I think what we're seeing on that front, I guess I agree with Chuck and Mike as it relates to the capital formation. We're now getting asked the question around exits. And the first observation is, I know I may not exit, so therefore I need to build something that's sustainable. So that's an observation you get in a meeting. But the next question almost inevitably is, but if I did want to think about an exit, what kind of profile do I need to develop? So this whole idea of building a company that doesn't need an exit, while it's true, we still see parties still curious about that exit opportunity. So I still think the exit mindset is still it's still pervasive within our space. It's evolving to knowing that you need to build a sustainable business, but that that exit. The exit discussion is still there. And oftentimes you want to exit to a public company. So then the question becomes, if I'm building a sustainable company that has modest growth or flat production with a decent yield back to my owner or my sponsor, when is the public vehicle going to emerge that actually will be supported by the public marketplace, that'll have a currency valuable enough to actually buy something like I'm creating? So I think now as it relates to kind of capital formation or capital evolution, I think we're all sort of starting to think through when we look up in 2 or 3 years, once public companies have adjusted to investor demands of lower growth, more return of capital, maybe a dividend yield that's competitive with the S&P 500, a sustainable business plan. The companies and the upstream companies that get to that profile, how will they trade? And might they actually be a consolidator once again? So therefore, I should probably have my entity set up to be accretive to whatever that public profile may look like in a couple of years. So I think parties are thinking about what might the investable public company look like in a couple of years, making sure I'm setting up my private vehicle that's accretive to that, because the option to still exit into a public company is still something that is, that private equity companies still want to maintain. So we're starting to see a little bit of that thinking as well.
Seems like the morphing of the private companies looks more like yield distributing companies to me. One of the questions we got on the chat line is pretty interesting. So if there's co-invest and we're all, what is the actual benefit? Is it just economies of scale, or is there real economies of scales of saying you see the larger private equity providers consolidating several companies in a particular region, maybe not even in the same region together? Is it just the G&A savings, or is that why is that happening? That's one of our chat line questions.
Yeah, I think it's I think at least our focus and conversations, both where we could help those situations or on the advisory side. One has been, yes, the G&A savings. And, I think that's not insignificant when you're looking at, $100 million equity investment, and you have, 2 management teams who may have total G&A of 5 million plus. And you think about that, what it does to your PV value over a 5-year basis. I mean, it has meaningful impact on value and ultimate exit if you can consolidate that and scale back total G&A. So I think the G&A is a big driver of it. But the other is I think is a big focus on just de-risking. And so as you're looking at relatively small businesses that are very dependent on the semi-annual borrowing-based redetermination and being worried that at any point liquidity gets pulled from you, getting scale certainly helps with that as well. And so I think there's one, an economic benefit of reducing costs, but the other is certainly, especially in this environment, a keen focus on de-risking. So in that case, if you have 3 portfolio companies, 2 of which are smaller, and at any point you could worry about liquidity going away, you combine those 3 into a bigger platform that just gives you, I think, just de-risks it. So I think that's so part of it's the economics, but I think part of it's just a real focus on de-risking.
So let's pivot a little bit onto a couple of things that are maybe following along with something Chad said. As we see more, it appears pressure is being continually placed upon capital providers to consider whether we want to argue climate change or not, but consider that to be part of the equation. ESG, a whole raft of potential items that would require some scale to be able to adhere to all the policy requests and changes. So are you guys being pressured, or you feel like that private equity and everyone is being pressured by that group? How would you answer that?
I notice no one wants to take that question. Since I'm out of the industry, boys, I'll go ahead. I'll take the team here. No question that there's a lot of pressure on the ESG front, and it comes from just my son, who's getting his way paid through college because of the energy business, doesn't let me know about it, but he won't let me follow him on Twitter because he's out protesting the evils of hydrocarbon and the like. So there is just a generational issue to it that folks are really passionate about. All these pension plans, from state governments, various teachers, etc. Those are all very political type organizations that ultimately report to a politician who ultimately has beliefs one way or another on climate change. So, a lot of the job is being able to, for those folks, is to follow what their boss ultimately wants, but also to have data about it so that they can discuss it with their boss and the like. And so it is a really, really big issue out there, and it's going to continue to be, and it's a million times worse than it should be, just because we've stunk as an industry in terms of making returns. So it's pretty easy to kick us while we're down, because as I like to say, we have 2 issues. We've got the green issue, but the other one's the red issue. When you're the worst performing asset category in somebody's portfolio, it's real easy to become a true believer in ESG. And to some degree, that almost becomes a self-fulfilling circle, if you will, because the less dollars you have invested, the less a piece of an overall portfolio you are, the more the reason not to invest in energy anymore. Because if we're 5% of a portfolio or 3%, just go buy Exxon and Chevron and you can check the box for energy. Why try to chase alpha, if you will, for 3% of the portfolio? Because if you're wrong, you tagged yourself on 3% of the portfolio or 5% of the portfolio, and you're 95 or 97, you've got to outperform what everybody else is doing. So it's here to stay.
Well, the problem is that our industry's dipped below a level to where it's meaningful as a component to the S&P. That's causing a pot full of problems, right? So that, I know no one really wanted to answer. They're not going to want to answer. You guys aren't going to want to answer this one either. But it's being widely suggested, and it kind of culminated in an article written by Bowden Gray in the Wall Street Journal recently that there is starting to appear to be collusion between certain banks and large capital providers regarding talking together about kind of sort of boycotting the industry. And you're going to see, we believe you will see, or I personally believe, I should say, that we will see antitrust type lawsuits. You know, I don't know if anybody wants to comment on that, or if you read Bowden Gray's article that the banks may have an antitrust problem due to the boycotting. But as long as they're not, if they're making their own decisions, that's one thing. But if they're actually talking together, that's a whole different thing. Has that been discussed, or is that how big a problem is that inflows from an inflow standpoint into your funds? Maybe that's the question. That's more of a soft.
Well, just real quick one, then I'll turn it over to Chad and Mike. Is just remember, if you're a bank, like any other business person, a lawsuit's just another cost, right? So you always weigh it. What's the cost of this versus what's the cost of that? I'd much rather be sued for antitrust and duke it out in court for the next 10 to 12 years than to have to be paraded weekly before the Senate and the House committees and have to explain why I'm polluting the world in front of AOC, and have to be pulled in front of the Biden administration and explain why I'm the largest polluter in 17 out of the 50 states. And so, the banks aren't in an easy spot right now because they do have issues in their portfolio that the traditional mechanism of reclaiming the assets and selling, really tough to do today. Plus the added pressure of actually owning those assets and having to live the next 4 years possibly under the Biden administration. So it's not an easy thing for those guys to grapple with.
Yeah, and I guess what I would say on the topic is, as it relates to the collusion point, that's not something that we would see firsthand. Certainly not at this point. So it's hard to comment on the actual collusion. What I would say, though, is circling back to something Mike had said in his opening, which is just the access to the RBL, whether it's through collusion or whether it's because of collusion is just reducing access, or whether it's because as an investment decision, the banks are deciding they don't want to be as exposed to the space, is probably the single biggest change to our space in the last 20 years. Just to try to put it into context, our industry has been propelled and driven and supported and by just access to an RBL, and not having that access to that capital is probably the biggest challenge that's facing the space. I will say that whenever you get into restructuring situations and you do engage with the banks to try to understand their perspective when you're trying to take a company out of restructuring into a new exit facility, their concerns around the business and how the business has been managed in some instances are fair. So some of the capital space is just based on a business decision based on returns and banks actually haven't lost real money of late. I think the amount of the capital leaving the space because of ESG reasons, while hard to quantify, I would suspect is at least equal to the amount of money leaving the space just due to commercial reasons. So Dave, I think I think the ESG side of it is certainly a real headwind as it relates to just access to overall bank capital. I think where it'll get more interesting, and maybe even the next evolution in the whole discussion, it will be whenever the attention turns from the fossil fuel companies to the next consumer within the chain of the fossil fuels, and you're starting to see some of the bigger companies who are well capitalized try to get ahead of that with PR pushes, with environmental investments, et cetera. Amazon has a big push, both kind of from a PR standpoint, but from a real practical standpoint, where names like that are actually trying to get ahead of, what ultimately could become one of their big problems.
Yeah, I
Yeah,
think,
Dave,
go ahead, Mike.
I was just saying, I think for kind of going back to a point Chuck made very early on is for banks to get back in, for people to be willing to overlook ESG, kind of the returns have to be there. And right now, as an investor looking at his portfolio, he doesn't have a reason other than a required allocation to energy potentially to be in energy. So it's going to take the industry to let this play itself out, start generating returns for a portfolio manager to look back and say, okay, now when I'm comparing my portfolio, looking across sectors, I actually missed returns by not being in energy, and kind of show the portfolio managers that you can earn those returns in energy again, for banks to come back in, for investors to come back in. So I think ultimately it's going to take being able to show that you can generate those kind of returns for people to start being willing to, not say overlook ESG, but get comfortable with ESG, because that's what it takes to generate outsized returns. And until those are there, it's the easy decision by these portfolio managers to just look the other way and invest in other sectors.
Well, one of the things that you'll get from, I believe wholeheartedly that the Heartbeat America looks a lot like oil and gas guys, and there was a cost for energy independence, and unfortunately we've paid for it. Our industry has paid for it and got very little credit for it, but in the form of some of the trade alliances and things we were doing with that leverage, we all benefited. But unfortunately, I think that you're right. Everything's being measured by one issue, one yield, one, what have you. I'm a firm believer that there's, that we're not divided red and blue at the banks. We're all green. It's about money. It's not green for climate, it's green for money. And I think they'll come around when I'm going to concur with Mike here, that when we look like that we are disciplined enough to yield properly, it will show up. Unfortunately, I think that we got a long way to go to get there. One thing that's going to happen, and I always, almost every one of these, I try to give a shout out to our younger people, because if you're a junior in petroleum engineering or a sophomore in geology somewhere, you got to be thinking, what the heck, this is too cyclical. It's not just commodity cyclical. It's the mode has compressed and the amplitudes have gone straight up and down, and it's almost impossible to sawtooth your way through without getting caught, especially with private equity money or any kind of leverage. So what our guys out there, and a lot of displaced people, they're looking for, where do we go? This is the leading edge of technology. This is a tech business, and where do we go? What disruptive technologies or niches that can be filled that you guys see out there? You probably see a lot of interesting things. I do just in my little world of people bringing in projects of, hey, look, we've got this kind of rod guide, or we got this kind of operation that can save money on the LOE side. What are you guys seeing people bring in? What kind of any disruptive technologies that you guys are interested, that we could tell our Petroleum Alliance folks and membership that, hey, here's something that you guys should look at?
Dave, maybe in a note of full disclosure, I might be joining the advisory board of an energy technology private equity VC fund. Kind of been talking to those guys for a while. So this is probably going to sound self-serving, but it's interesting when you think about the oil and gas business. You can sit there and look at the amount of automation it has vis-a-vis what it's doing, and make a case that it's the least efficient industry in the world, even less so than government entities. I've seen, a funny little stats of the DMV versus an oil and gas company. And what I think that misses, though, is we as an industry have always spent a lot of money and gone really, really high tech on the things that mattered to oil and gas companies. So the late 90s, 3D seismic, spent a lot of money. That was really high tech stuff, did a lot of great work, finding bright spots. And then when we moved into, you know, really being the provider of the marginal barrel for the rest of the world, kind of the age of the driller, I mean, that's as high tech as it comes, going down, drilling a horizontal well, doing the multi-stage fracking like we do, like we were doing. But at the end of the day, you know, the back office, we were still keeping that on paper ledgers. And I'm being a little flippant here. And, you know, production wise, because, you know, drilling a $10 million well instead of an $11 million well really made a lot of money. And what your IP was helped you make money. You know, 6 months later, the production really didn't matter. And you've got basically a pumper driving by with a broom handle, sticking it down in the tank, and then faxing in the production numbers to the company. We spend money where the value's created, but we wouldn't spend money automating. And I think all that changes. I truly believe, like I said earlier, we're gonna be the age of the plumber. We're gonna be producing out for a while. There's a lot of excess capacity in the world. Not sure there's gonna be any growth in oil demand, just given COVID and all that. So we're gonna be producing out. And when we do that, yeah, we're gonna have to do a lot of automation. You know, there's no reason that the pumper needs to go by every day. We can do a lot of that with telemetry. We need a lot in the way of artificial intelligence, helping us run the pumps, figuring out how to maximize that amount of money. And the other big shift that's gonna happen, in addition to a lot of technology being laid out just on producing our wells out more efficiently, is we're going to become a low margin business, right? Because if we can cut LOE from $15,000 a month on that tank battery and well to call it 10, that's really going to matter. And so we're going to become a very low margin business. And when you're a low margin business, every low margin business out there, when it gets to that point, automates everything. So I think technology in oil and gas is just going to be a huge winner over the next 5 to 10 years, because it's a totally different game than what we've been playing in the last decade.
Well, I have a lot of people that come in and talk about, and I said, look, you know, anything that's that really lowers the cost curve, the low cost operator is going to win the game. But one of the difficulties, first off, telemetry is expensive. It's expensive, and true operating by exception was what needs to happen. That's kind of what you alluded to. One of the problems that has to be considered is in your standard joint operating agreement, in the AAPL form, there's an implied duty as to be a prudent operator. And is it prudent not to drive by the wells if something happens? And so you're weighing the legal costs of if something happens. You certainly cannot operate by ignoring. You can't run your Aries list and say, okay, these wells are negative, we're not driving by them. So there's a big battle going on in an effort to drop costs that you know, unfortunately, the human cost is usually in the top 3, as you just alluded to from a pumper standpoint. But
and Dave, you're making a really good point, because it's that legal duty, it's the need to drop costs because we're a low margin business. But one of the things I've been talking to this fund about is there needs to be a financing model to that, because at the end of the day, if telemetry really is a 1-year payback, you probably should do that. But I don't know how many oil and gas companies are willing to invest, you know, a 1-year payback on a big fancy software system if they don't know where their interest payments coming from. So there's also going to have to be some thought given to how do we finance that technology to an industry that's hurting right now.
yeah, well, there is some true cost savings associated. You know, in our world, we've looked at telemetry at the bigger compressors, maybe that at least you see a problem that you go to first, and maybe you have less folks, but you simply can't just ignore and not drive around the wells ever, or in some sort of fashion, or you'll give all your costs back with one big leak or one big environmental release or something. So we're kind of bumping up against our time, and I don't want to overstay our welcome getting you guys, since you guys are so gracious to be on here, but for our guys, let me pose this question and get all three of you to answer. You're a 10 or 15 year engineer with a production background, and you are displaced by no fault of your own, just life in this business. What do you tell that what should that person focus on? Should they, let's just assume that they're, what would you tell them to do? Would you tell them to pivot and find something else to do? Or what would you tell them let's kind of focus it on staying in the patch, and give your thoughts.
Sure. I'm going to say, Dave, that's a great question, because that's what you do whenever you're gathering your thoughts. And so I will admittedly, in front of this big audience, say I am gathering my thoughts real time. It's such a personal question, because I think whether you are displaced or not, whether you're an executive or whether you're a new person who's just joined, you're definitely worried about the existential crisis that in this industry. It's just human nature to have that worry. I suspect everyone on this Zoom call is, in a moment, since March, has said, "Wow, what's the future going to look like for the business, for my team, for me personally?" So it's a very personal thing, and it's a very, it's a very fair thing to be thinking about. I guess what I would say is, first of all, you got to do something you love. So if you love the business, if you love oil and gas, if you love energy, find a way to stay in the business. If you love the piece of the business that you're doing, but you don't love oil and gas, think about switching sectors. So for example, I think about my team, our team at TPH. We have, a handful of really talented mid-level professionals who are excellent with big data management. Excellent. I mean, they can analyze data quickly, they can analyze data precisely, and they can make judgments around that data. It happens to just be engineering data, but it's just big data management. And I seem to be thinking about that person, thinking, if you love the energy business, don't give up. Let's give it some time. But look, if you just love big data management, you do have a skill set that's transferable. So I think the first thing you got to think through when you're that kind of a person is, if I do have a transferable skill set, do I want to stick with the business or not? And then you got to pivot back to the first point I made. If you love the industry, stick with it, and let's see, what it looks like when we come off of, off the bottom here. So I guess that's the beginnings of how I would start to try to frame a discussion with somebody at that level.
Chuck, you got any thoughts?
Yeah, it's really interesting. I was starting to work on this speech and never wound up getting it written because all hell broke loose. But, if you look back at technology in the late 90s, early 2000s, NASDAQ lost 75% of its value. All these venture capital dollars were lost. And that's because it was a technology back then was a growth business. It was dollars per eyeballs on websites, just like we were kind of chasing dollars per acre, et cetera. And technology got wiped out. But at the end of the day, so when you looked at just value and stock prices and all this massive collapse, if you looked at underlying fundamentals of technology and you looked at web users per day, if you looked at commerce sales per day, et cetera, all of those metrics just grew right through that period. And, you know, today the largest companies are Apple, Google, et cetera. I mean, at the end of the day, transportation is oil, period. I mean, Boeing and Airbus don't even have patents on an electric plane yet. So to think this industry is going away is farcical. We have a massive destruction in value that happened, but the underlying business is still going to be here, and it's pretty complicated. Whether we're producing 9 million, 10 million barrels a day, whatever it is, there's a lot of stuff to be done. And so the industry is not going to go away. It's going to need people. It's going to require us, anytime there's a downturn, to sort of think through what are next business models? How do I get ahead of it? Is it working with technology? You know, to Chad's point, is it potentially taking your skill set and going outside? You know, I would actually think the millionaires and billionaires we're talking about in 5 years are people that went out and bootstrapped themselves today, because, you know, the institutional model, I think, of getting backed by a private equity fund and going out and spending, you know, 200, $300 million, I think that's just dead, at least dead temporarily. But there's still going to be a lot of things to do. And, you know, I hate to sound like I'm on Sesame Street, but invention is the mother of necessity. And that's just where we are. And if you got laid off, and trust me, I've done this, you got a blank sheet of paper in front of you. To Chad's point, write down what you like to do and all that. Think through things, think outside the box. Because I will say, what I've been amazed at since I've been an unemployed guy is just how much of my day over the last 20 years was what I'll call stuff that was just inherited. We did things this way because we're a private equity firm. We did things this way because we were at Kayne. And it's been interesting sitting there with my white sheet of paper just going, hey, I want to go do this. Wow, I don't have to do it that way. I can do it this way. And so, you know, as kind of depressing as it can be, to lose your job and be in that spot, it really is a blessing if you can look at it that way with the white sheet of paper in front of you, because this business isn't going away.
And I would say, Chuck, you
Go ahead,
Chuck, you do not sound like you're on Sesame Street. You sound like a commercial Dr. Phil. You look like you're on Sesame Street.
I'm joking. People say,
Mike, you got some comments to answer that question?
Yeah. The only thing I'd add is, I mean, just thinking about the themes we've talked about on this, you know, short call is, you know, focus from, you know, it wasn't that long ago you were looking for, you know, the guy who had the most experience in drilling horizontal wells and latest fracture techniques. And now the turn is to production optimization and what are ways to reduce costs. And so I think part of it's just thinking about the themes and where the focus of the industry is. It's going to be around, you know, the production side of the business, around, you know, to Chuck's raised technology multiple times, which I think is right. And then the other part to think about when you're saying thinking outside the box is they're through this environment, as we're seeing now and will continue over the next couple quarters through these restructurings, there's going to continue to be a lot of non-traditional owners of these assets. And so when you think about RBLs ultimately, so you think about the banks end up owning a portion of the asset, or how do they get rid of the asset? And so are there going to be regional banks who are stuck holding a business or owning a business? What do they do with it? So I think there's going to be a number of entities and owners and investors who end up through these restructurings needing to manage and own assets that they never expected to or were equipped for. So I think all of that's going to create opportunity in areas for focus versus going to the next large independent oil and gas company. It's where also there are going to be, you know, other non-traditional owners who are going to need help. And so I think that's just another area to be thinking about and place to focus for new opportunities.
You know, I think thank you guys for that answer to that question. I think that what I would leave that example I gave, but just a general, is the simple word of attrition. I'm actually the last year of the baby boomers, and a lot of our experience and a lot of folks are leaving the industry just because we're getting older, and there's not a place. Some of us are displaced. Some of us are dabbling. We're just not driving like it used to be. And we're having less and less folks coming into the industry. I'm very concerned about petroleum engineering enrollments, geology enrollments. I just think it's crashing right along with the decline rates. And I think we are setting ourselves up for, we all know that horizontal wells hyperbolically decline. I mean, we're in a historic time of decline that I think that there's a very bright picture not too far out on the horizon. And so, and maybe I was on a call yesterday, and a guy I think a lot of in our industry, Kim Hatfield from Crawley, he said, well, first off, we're all optimists. He was answering a question. We're all optimists, or wouldn't be in this business to begin with. So I am optimistic, and I do believe that this is I like that age of the plumber, but it's also, this is a tech business that's going to continue to rose to every challenge. And so I think for the folks on the phone that had the opportunity, this is 3 of my most favorite guys I've worked with in the oil patch that I somehow coerced to be on this call. And I think their insight's important and uplifting. And so join, if you're not a Petroleum Alliance member, join the Petroleum Alliance. There's economies of scale. There's power in our numbers. So do that. And thank you guys, all 3 of you, for being on. It was fantastic, what I was hoping.
Hey, thanks, David.
Thanks for having us.
All right, guys. Thank you. And thanks everybody that was on.
Thank you. Thanks, Dave. I really appreciate it.